Our second lecture of this course would be Introduction to Money and Monetary Systems. Money is a phenomenon that is a fact of life. It is everywhere, and at the same time there is quite a bit of misunderstanding what it actually is. First of all, as sort of a heads up, money is not currency. Actually, it is broader term, and it includes many more things. We could define money as any circulating medium of exchange, including coins and paper, banknotes, but it could include also demand deposits or any other commodity that is widely accepted as an exchange medium. For the purpose of economics, however, money actually has three distinct uses, some of which are not adequately covered in the before mentioned definition. These uses are a medium of exchange, which has account value which could be used for a unit of account, and at the same time it could store value. Why did money evolve at all? Well, simply because before money, the exchange of goods and services was basically barter exchange. Barter means swapping goods and services for other goods and services, and it is likely very difficult because there need to be at least two conditions fulfilled. First, barter requires coincidence of wants of two different entities. So basically this means that if I want to trade my furs for somebody else's rice, I will need to have exactly at the same moment me having extra furs and the other person having extra rice, and at the same time me wanting rice and he wanting furs. Basically, this is a very hard set of conditions to be achieved. So basically what happens is that the trade is slowed considerably because there is rarely coincidence of wants. Many societies have used many things as money, including stones, shells, elephant tails, furs, salt, pieces of paper, and so on and so forth. Some of these types of money have withstand the test of time. Some of them have disappeared into our past. Nowadays, the system is obviously mainly paper money backed by a government. But let's take a look a bit down the history lane and see what has occurred so far in the last several thousand years. The evolution of money has passed through several phases. First, we used to live in a barter system where when everyone had to exchange his or her own goods for other goods and services. Next, there was a phase of commodity money when a given commodity was used as a money. So, for example, on a given market, we could use seashells as a universal exchange unit. After that, of course, came the time of paper money. Paper money started their existence in China. Nowadays, we could say that some additional instruments are used for money. Currently, we are in the era of a new development of the money market, which is the emergence of electronic money. Some words about the barter system that we used to participate in several thousand years ago. Barter system involved the direct exchange of goods and services for other goods and services, and it was very difficult to have any sort of trade for the following reasons. Lack of double coincidence wants, which means that it was really hard to find somebody that wanted exactly your goods and willing to trade his goods. At the same time, you were willing to get his goods and willing to trade your goods for him. There was a lack of common measures of values. There was difficulties in storing value. So it is very hard to store value in, let's say, sheep fur, because they get spoiled over time. There wasn't any sort of borrowing and lending and any sort of deferred payment. Basically, whatever you have in your pockets, you use it for payment, and that's that. So trade was slow due to that fact. Some of the goods that could be used for barter were basically indivisible. If you would like to sell a cow, for example, you could only sell the whole cow, not half of it. So next, it came the time for commodity money. Commodity money meant that a given good was widely accepted as a sort of money on a given market. For example, rounded shaped stones, or elephant tails, or metallic tools. What is the problem with the commodity money is that an accepted commodity on one market was unaccepted commodity on another. So basically, if you needed to trade on another market, you needed to keep other positions, other goods for money. Next, in the late several hundred years, the emergence of paper money became true, and paper currency that circulated for transaction-related purposes have been around for the several hundred years. They did not have value of their own, but there was somebody to back the value. So basically, there is somebody to give a guarantee that this piece of paper worth something. The printing of paper money is typically regulated by a country, typically by the central bank or treasury, in order to keep the flow of money in line with the monetary policy. Something that the new wave of electronic money is disrupting heavily. Speaking of electronic money, they are the newest trend in finance, of course. In the last tens of years, let's say last 30, 40 years, transactions became more and more over internet and over electronic devices. So all the financial institutions started storing electronic votes instead of physical votes. And there are two directions of development of electronic money. One was the emergence of electronic payments through credit cards and debit cards, of course. And the other was the newly arrived concept of cryptocurrency. There is an important remark here to be said. There is a distinguished difference between electronic money and cryptocurrency. Typically, with electronic money, the money supply held on computer systems are under central control. For example, bank or state financial institution. Whereas in the cryptocurrency, the security is kept by a mathematical algorithm, and the main principle is distributed consensus, where everyone knows who owns what. So this is a big difference. In the coming lectures on the next levels, we are going to have time for special discussion on cryptocurrency. So now that we know the evolution of development of money, let us speak some about the function of money. There are different opinions among researchers on what are the functions of money. I'm going to use the widest possible description here, in which money have 5 different distinguished functions. First of all, it is the function of medium of exchange. Next is the function of unit of account. Next is the function of storage of value. Next is the function of standard for deferred payments. And finally, easing of transfer of value. On the medium of exchange, which is the first and most important function of money, by definition, medium of exchange is anything that is used to determine value during the exchange of goods and services. Money allows us to use system of trade beyond the barter system. Your money acts as a common ground for determining the value of the deal that we are making. At the same time, next important function of money is money as a unit of account. Money can be used as means to compare the values of goods and services. They can be used as quantitative estimation of what do we have, and they could be used for accounting, and they could be used for storing information and analysis of their value. Money as a unit of accounts allows us to compare similar offers for goods and services and determine the best value. Third important function is money as a storage of value. This is the function why precious metals have occurred to be an important part of money markets, because precious metals could concentrate a lot of value in a very compact form. So money is used to maintain the value of a transaction over time. If you receive monetary compensation for goods or service, the actual amount that you receive does not change if you do not use it immediately. So you can spend or exchange your money at a later time without the penalty of losing some value. However, and we're going to speak about this later in the course, the functional value of stored money may change over time due to other factors. Okay, the function of money as a standard for deferred payments. One important aspect of trade is the ability of someone to pay later than the actual exchange of the goods. This gives this person the opportunity to sell the newly acquired goods, get the payment from them, and return to the original deal and pay on this deal as well. So in order to have this opportunity, money actually is used as a standard for measuring the deferment of payments. Debt are easily returned back with the same value of money, or, and we will speak about this, debt could be repaid with an increased amount of value should this is needed or contracted by the deal. The last function of money is money as transfer of value. Money has the ability to transfer value from one entity to another. And the first entity or the first individual knows how much he or she has given up and in exchange for what. And the second individual knows how much he or she has received. So even if we have a gift for someone, we can always easily estimate the value of this gift by using its money value. Now we know what are the main functions of money. But what are the characteristics of good money? Well, there are several characteristics that could improve the quality of money, and they are mainly concerned with the physical aspect of the money medium. So these characteristics include durability. Durability means that the item must be able to withstand being used repeatedly. This is the reason why we ended up using coins at one point in our civilization because we needed to have durable currency. Items that are considered durable are coins and paper bills used as money when they are produced specially for this purpose. Next characteristic of good money is portability. Money should be easily transported from one point to another. They should be carried easily by a single person. And this is why small pieces of metal, as coins, have withstood the test of time and have been and yet are used currently as well as money. Divisibility is the characteristic that says that money can be easily be divided in smaller amounts. So if we have a piece of a diamond, of course it is portable, it is a durable payment, but it is very hardly divisible. So this is the reason why coins and banknotes have emerged to be successful payment method. The next thing, the next characteristic is uniformity. Uniformity means that from the first sight of, from the first moment that you see a banknote or a coin or other form of money, you should recognize that exactly what it is and how much value does it carry. Uniformity means that all versions of the same denomination of currency must have the same purchasing power. So, for example, a $100 bill issued in the 1990 and the $100 bill issued in 2010 should have exactly the same purchasing power. Next important characteristics of good money is limited supply. Limited supply means that there are restrictions on issuing money and circulation of money is controlled by someone. The responsibility for maintaining an adequate money supply so far has fallen on the governments and central banks. Typically, they are in charge of issuing new money supply and taking out of turnover the old money and destroy them adequately. And finally, the final characteristic of good money is acceptability. Acceptability means that everyone must be able to use the money for transaction. For example, in the United States, this is indicated on the paper bills by the notion the note is legal tender for all debts, public or private. It has not always been the case that the banknotes have been widely accepted. There was a rather interesting part of financial history when there were many issuers of banknotes and not all of them were widely accepted. Even now, there are several national currencies that are not widely accepted across the world, and in order for the people holding such money to purchase something from outside of their country, typically they need to have some sort of exchange of money beforehand. Speaking of money supply, there are three types of money aggregates, and all of them are different on the basis of their liquidity. Liquidity means the ability of a currency or types of money to be spent quickly without any additional expenses. So the three aggregates are called M1, M2, and M3, where the M1 is the narrowest definition of money. Hence M1 is the most liquid. M1 includes all currencies, coins and paper money that are in public. all checkable deposits that are easily converted to paper money and can easily be spent. Next money aggregate is M2, which is broader definition of money, and it includes M1 plus a number of near monies, the so-called near monies, such as saving deposits, including money market deposits, accounts, and small deposits. By small, we typically mean less than $100,000. These near monies can easily be converted into currency and checkable deposits, and this is why they are next in terms of liquidity to M1. And M3 is the broader definition of money. It includes M2, but also the large time deposits, balances in institutional money funds, and other liabilities that could be converted to money but are less liquid than M2. So why large deposits are less liquid? Because if you go to the bank and would like to withdraw $100,000 or more, typically they would tell you, we need some time, sir, to gather some currency for that transaction, and this would mean basically restriction on liquidity. One important note here is that the current monetary systems are called the so-called fiat monetary systems and fiat types of money. They are basically an item, typically paper, without its intrinsic value, so it doesn't have value of its own, but it has been declared to be money by the government. So, for example, a central bank basically prints out a paper. The paper itself has next to nothing value, but the bank declares that this is a official payment currency, and it guarantees its value by a statement somewhere on the banknote. One important aspect of money is its relationship to prices, and there is a negative correlation between the value of money and the general level of prices, which basically means that if some type of money becomes more valuable, it basically lowers the prices of the goods in general. And the other way around, the lower prices tend to raise the value of currency because fewer dollars are needed to buy a particular amount of goods, services, or resources. Why is this important? Because everywhere on the world there is a single phenomenon that is happening all the time, and it is called inflation. Inflation basically is lowering the value of money in relative terms in comparison with the general price levels. And why inflation is important? Because very high levels of inflation can result in basically breaking down all the important functions of money. It could break down the money as a medium of exchange, because nobody would have the trust in money to accept it as a payment. After that, it would break the money's function to store value, because nobody would be willing to take such money that would lose their value. And obviously it would break the function of unit of account, because nobody would believe in the stable value of given types of money. There is an important relation between money and general price levels. Okay, so this concludes our lecturette on money and monetary systems. What we have achieved in this lecture is that we have explained what is money. We follow the evolution of money starting from the barter system, going through the commodity money, going through paper money and now discussed the electronic money. We explained the functions of money as a medium of exchange, as a unit of account, as a storage of value, as a standard for deferred payments, and as an easy transfer of value. Finally, we reviewed the characteristics of good money as durability, portability, divisibility, uniformity, limited supply, which means scarcity, and acceptability. At the end, we just made some notes on the relationship between value of money and the general price level.